All right, let's keep going. So let's think about it. Imagine you're going on a road trip to a place you've never been before. Specifically for new students, if you don't know, go for it. Let's say this is where you are, and this is where you want to go. In order to get to your destination, what are 3 things that you need to get there if you're starting all the way to the left? Everyone in the chat, tell me what are a few things that you must have in order to get to your destination? Everyone go ahead and start commenting what you think. What do you need to get to your destination, to a place you've never been before? All right, right? So let's think about it. The first thing you need is you're going to need some form of transportation. That's a given, right? So your first form of transportation you're going to need in order to go anywhere, right? You always need a vehicle that's going to take you to your destination. And we're talking about something that's not close, right? So the next thing that you need is, after you have your vehicle, you need a way to get there, right? If you've never been there before, you need to figure out what's going to allow you to get there. And that's going to be a map, some form of navigation system, GPS. So now you have 2 out of the 3. You have your directions on where price is going to go, or where the destination is, how you're going to get there when it comes to directions. What's going to allow you to get there is going to be your transportation, and arguably the most important factor that's going to allow you to get to your destination is going to be the gas. It's going to be your gas. So all along the way, if you have your car and you have your destination, if you do not have enough gas or fuel in your vehicle, you will not make it to your destination. But if you have more than you need, it's going to be utilized for a future trip, right? It's going to be utilized for a future trip. These are 3 things that you must have for any car trip, for anywhere, right? Well, that's where we need to think about the markets. The markets are an entire roadmap, always in search of a destination, but always need enough gas to get there. And price, how price is moving up and down, higher and lower, that is your vehicle. Your vehicle is price that's going to allow you to get to your destination. But to get to your destination, you need fuel at gas stations to get there. And what are these gas stations? The gas stations are the institutional and retail traps, or the liquidity pools, where all of these types of traders are losing. I'm not talking about SMC and retail, they're one and the same. But institutional liquidity, understanding retail liquidity, by understanding where traders are losing, those are the gas stations that's going to allow you to understand where the destination is. So like we talked about, if you have enough gas, you're going to get there. If you don't have enough gas, you're going to have to fuel up before you get to your destination. So if not enough gas is collected, you can't get there. If more than enough gas is collected, it's going to be used for a future trip, or for you to keep going maybe to a further destination. Very important is correct order blocks are what's going to be lying after your gas stations. So when your price or your car is fueling up, what's going to be the ignition after you fueled up for your trip, an order block is what's actually going to be like a Super Mario Kart accelerator. It's going to allow you to just boom, push directly in the opposite direction. And that's what order blocks do. Your order blocks are located after your gas stations. Those are what's going to set you right back on the right track for price. So by identifying where everyone is losing, we know where to win. That's going to be said many times, so keep thinking about it. Before I win, I got to learn how to lose. Last but not least, now we're going to be introducing the retail strategies that provide the gas that will drive us down the road to victory. So first block, retail liquidity, advanced liquidity 201. Equal highs and equal lows. We already know what these are, so we're going to fly by them, right? We already know what equal highs, equal lows are. So let's think about it. What do retail traders see? We know that retail traders obviously see support and resistance. Support and resistance, when you're looking at equal highs, equal lows, it's just a conglomerate area that has at least two touches, but if not 3. These touches, it doesn't matter if it's candles, bodies, so on and so forth. But what is essential is it's building some form of ceiling. It's building some form of resistance where we know traders are going to be selling at. So if traders are looking to sell, we know where their stop losses are, and vice versa. If we know that we see, oh, here's 1 touch, 2 touch, 3 touch, 4, we know that looks to appear to be some form of price floor. So this is where retail traders are going to expect to sell from, expect to buy from, right? So why do retail traders use this? Because it makes sense to sell and buy at areas that have previous rejection. This indicates some form of threshold that's going to allow the market to reverse. Now, if you don't have a stop loss, you might get lucky, but other times you're going to be completely screwed. That's why equal highs, equal lows are the most basic form of retail liquidity, but just a very small piece. What market conditions do they occur in? Support and resistance primarily occur in ranging conditions, as traders are typically trading zone from zone. I, for one, know that when I first started with price action, I was trading zone to zone, whatever made sense, because that made sense. So you're going to see support resistance all over the place. We don't spend too much time on it because you guys should already have that understanding. So now equal highs and equal lows, right? We know that these traders, they do not have their stop losses exactly at, these areas. They could be 5 to 10 pips afterwards. So the purpose of these types of liquidity is to build a pool by accumulating buyers at support and having those sellers distributed at resistance who got in prematurely. Again, everyone who's looking to sell here, and they see all these rejections, they're going to be entering after that. And the more times that you see a specific level rejected, you need to think about the purpose behind that. Is the more times that people are trying to sell and price is building a huge resistance, you need to think about, damn, there's a shit ton of money that's lying after where they're looking to sell, because the more touches that you have, the more rejection indicates the more amount of sellers who are trying to sell the market, which means the more amount of sellers, in terms of money, a much more amount of stop losses are lying above. So what happens is after there's a ton of sells, stacked, price liquidates them. And then based on the amount of liquidity that's building, you can expect a huge move in the opposite direction. But you can understand how large the move that will happen based on how much liquidity is building before the move. If it's just two highs like this and price were to wick it out and drop, it's not going to be as expansive because there's not a lot of stop losses lying above those two highs. There only might be a couple, relatively speaking. So now from a liquidity perspective, what do we look to do? We look to sell above resistance and buy below support. Knowing that retail is going to be looking to sell here, we need to be looking to sell above. And if we want to sell above, what's going to actually cause price to reverse? Two factors. And this is important. Students know I say this all the time. There's always two things that need to happen in order for price to go anywhere. Enough gas needs to be collected. And two, there needs to be a strong enough order block that'll cause price to get to its destination. So in this instance, we know where all the gas is. It's above here. Where's the stop or where's the order block? The order block is going to lie after our highs. So we're going to want to look above over here. So that's going to be our order block that we're going to use after liquidity is taken for then us to sell all the way lower. So it becomes very simple. Where's the gas? Where's everyone losing? Where they have their stop losses? Then identify the order block that lies above their stop losses, enter on that order block, and then price obviously will liquidate in the other direction. We get in where they get stopped out, right? You have retail who buys low, sells high. You have SMC who buys lower, sells higher. You then have institutions, algo, we buy lowest, we sell highest. And of course, the expected outcome in this scenario, sellers get taken out before price sells off. Sellers get taken out before price sells off, and buyers, they buy before price goes in the opposite direction. Always going to be the same, right? So the initial application of this concept. Determine the trend. So everyone, what I want you guys to take 10 seconds and tell me based off your knowledge, not about structured BOS, what does the trend appear to be like? Are we in an uptrend, downtrend? Everyone just either draw on the chart or type in the chat, up or down. All right, so we're in a downtrend, very clear, right? So we're in a downtrend, all right? So after we're in a downtrend, great, we know that we're looking to sell. Next thing we need to do, if we're looking to sell, we need to ask ourselves, where's the liquidity? If we're in a downtrend, what type, do we look for equal highs or do we look for equal lows if we're looking to sell? All right, so if we're looking to sell, we look for equal highs. Where are all the equal highs? Everyone, again, engaging, everyone participate, analyze. And we're forecasting the move. Remember, this move has not yet happened. You're going to be forecasting it. So everyone annotate on the screen. We can clearly see here, we have our equal highs right here, very evident. We have one touch, two touch, three touch. All of this is acting as a resistance, right? Next thing that we do is we then anticipate an order block, right? We anticipate an order block. So we know that if we have all these equal highs right here, we see all over here, we have one touch, two touch, all of these relative pool. This is going to be used as some form of support here. We have our resistance here. Now we need to ask ourselves, we want to sell lower. Where is the gas? It's above our equal highs. So now where is the order block? Everyone go ahead and identify the order block. All right. All right, so then let's see what happens, right? Got our equal highs right here. This is our order block right here. For those who said over here, remember about order blocks. This one, yes, this was an order block, but what happened? It was already mitigated. Once an order block becomes mitigated, it's not relevant. It doesn't become relevant anymore, right? And this at a surface level, it doesn't become relevant. We only want an order block to be mitigated once. For those current students who know, there's a reason why it can be mitigated twice, but we don't have any information on that right now, right? So this is the only order block. And why is it this? Because over here we had an imbalance, but the imbalance was filled. It was mitigated. Perfect. So that's now taken care of. We know that this order block is not valid. We got to look above here. So where's the next order block with imbalance? We have a little gap right here. We have our imbalance. We then have our order block. So this becomes our valid order block. Now everyone go ahead and anticipate logically what the new move is going to be. Boom, right? And so that combining everything that we just talked about, exactly. In order for us to get to our destination, which is down here, we need gas to get there. Where is going to be the gas if we're in a downtrend? Our gas is going to be above highs. So this is the gas that we need to collect at the gas station. This is then going to be the order block that's going to cause price to go lower. And then this is going to be the new destination that we're targeting, because we want to be targeting new liquidity. We're going to be targeting new lows. So take out a high to then take out a low. And that's how we are going to be looking to sell. And exactly as such, right? Let's go through another one. Why is this not? Hold on, y'all. That's what some issues we had this morning. Things were not copying correctly. All right, so the first things first is if I were to do this, well, I'll just walk you through. In this case, right? I don't know why all this was inverted, but we can see here, based on this, the first thing we want to do is determine the trend. In this scenario, all of this to the right over here was hidden. This is all hidden to the right. Now, when we can see that all of this is hidden, the first thing determining the trend, well, based off this, we can tell we're kind of going bullish, right? So after we identify that bullish trend, we then want to ask ourselves, right, exactly, if this is where we want to make new highs, right? If that's going to be our destination, where's the gas? The gas is going to be below our equal lows. Again, we have one low, we have two low, three low, four. Someone's looking at this as a support. So then we look to buy below this low. And where's the order block? The first order block with imbalance right below. We can clearly see right here, right? This imbalance was filled. This is our only imbalance right here, right here. This is our order block. So if this is our destination, this is going to be the gas that's needed to get to our destination. So gas is going to be collected, and then we know price is going to go higher. Why? Because our destination lies at equal highs, very clear resistance that everyone's going to be looking to sell it over here. So now we're starting to develop not just the understanding of liquidity, but how price is actually going to move to get there. Always logical. Of course, then it'll just end up going all the way there. So in this example, we're going to do one more, go on to the next one. Everyone go ahead and identify, in this case, determine the trend. What is the trend? All right. Everyone's saying buys, right? Awesome. Yes. So we are bullish. Great. We're bullish. After we identify the trend, next thing, what's the next thing we identify? If we are in a bullish trend, where do we look to buy below? Beautiful. Let's do it one at a time, right? Great. Now we know where we're going to be buying below. Awesome. Right? Now we have where we're buying below. And the last thing we need to identify is what? If we know we're going to go higher, we have our liquidity. Where's our order block? Boom, right? This is our order block. Where's the first imbalance below? Our first imbalance below is where? Well, this imbalance has already been taken care of, right? Where's the next gap? Boom, next gap's right here. This is our order block. And remember from the video, it takes out, order blocks must take out liquidity. This order block takes out a previous wick, indicating money has been efficiently swept, and this is where the orders are still placed. This is our valid order block, right? So this is our order block. Now, how do we anticipate price getting to the gas station and to then go to our destination? What are we going to anticipate? Beautiful, right? Starting to really build purpose for moves, not just it's going to go here. How's it going to move to get there? So exactly that, right? All equal highs over here. Here's our equal lows. We're going to have to take out gas from above a high to then get to a low, and then a target, right? New highs. Boom, very quick. This is just how the principle of liquidity works at initial application. Even equal highs, equal lows. We already know this, but we're transitioning to not structure-based trading, but liquidity-based trading, right? So this is very simple. Identify the trend. Trend line. Are we going higher or lower? Higher. Buy below equal lows. Order block below to then target new equal highs, right? Awesome. Awesome. All right, the next type of liquidity is key zone liquidity. Like I said before, we have traders like myself way back when who traded from zone to zone. So this is called key zone liquidity. In this instance, what do retail traders see when they are identifying key zone liquidity? Key zone traders are viewing a zone that has been used several times for both buys and sells in the past. And it acts as a zone of contestation. So when you see over here, this was used as rejection. Over here, price broke it, used it as a support. Price broke it again, used it as a rejection, right? Rejection. Then in the future, right? What did price do? Came back and kind of used it as a support. Then used as a resistance, another support, so on and so forth. It's a zone that is indicated by buys and sells that are both lining up in an area, right? So of course we have all of these equal lows down here. We know that this is an area of key zone. Also here, we see that we have a zone of equal highs or still more key zone, all used as one touch, two touch, three touch, four. So what's the point behind this, right? Whenever a zone is broken, Retail is going to be looking to sell on the retest of the zone. Whenever a zone is broken to the high, they're going to be looking to buy on the retest of that zone. So why do retail traders use this? With retail logic, it makes sense to take positions at areas that have continually be rejected off of. And once broken, looking for the retest of that area. Once broken, look for the retest to then continue the trade in the opposite direction. Market conditions, specifically key zone liquidity, this occurs in ranging market conditions where there's a lot of ranging going on for buys and sells. That's going to build that layer of key zone levels. We got another 15 seconds and we're going to continue forward. I'll give you guys another few seconds. Keep going. Again, if you don't write them down, have questions, refer to on your piece of paper. All right, key zone liquidity. Again, furthermore, there are traders buying and selling within a range with no clear bias, and they fall into these traps of areas that act as a turncoat support and resistance that have several rejections and retests. This is the same image we saw to the left, right? And then what do we see? If you see a price that has been rejected as resistance and then as support, if you look for an order block over here, it will not work. So the purpose is we are looking specifically for retail traders to get in positions within the range, unsure of their bias, right? So it's causing them to be in both buys and sells because they don't know which direction the market's going. How do we view this is going to be based on the liquidity perspective. We identify bullish or buy order blocks below these zones and sell order blocks above. So if you see an area that was previously used as a, break and retest, or a key zone that was broken a zone and then it retests the zone, do not look to buy there because every other type of key level trader is going to be looking to buy there. If it's used as a resistance, right, in the past and it breaks it, don't use it. Don't look for an order block that lines up with your key zone. Do not. Don't get caught up in the choppiness. If you're looking to buy below, right, a key zone level. If you're looking to sell, right, if you see a previous level broken, sell above your key level zone. If you're seeing a key zone, do not sell in the zone retest of it, sell above the retest, or better yet, just outside of the zone as a whole. The expected outcome in these scenarios, price will continue to accumulate retail positions within the range in order to gather enough liquidity to create an impulsive move to break the range. All these traders, again over here, who are looking for sells, where are their stop losses, right? These sells are in place specifically to cause a whole bunch of liquidity or retail sells stop losses to be above these highs. So that's why they're building this whole range. One end of the range or the other is going to get broken, and the range internally will stay intact, and the lower end or the right end of that range will remain intact to then break the wrong end where all the liquidity is building. So even there, you might say, well, there's all these, there's all this support. Yes, there is all that support, but there's a specific reason it worked, and you're going to learn here in just the next block. All right. So key zone is the next one. So now what I want everyone to do is go ahead and identify the areas with a box tool, a line where there's clear sells that are being used, clear buys, and then all in between buys and sells that are being rejected in the same place. So go ahead and identify like the key levels that make a lot of sense. Give you guys 15 seconds, 20 seconds or so. And there's no specific rules for this. It's just what seems to be the most liquid areas for these types of traders. And I know it's always going to end up being like a drawing book, but I just want to see. Exactly, right? So give or take, you guys all have these zones drawn out right here. You guys want to stop annotating for a minute? You guys have all of these zones drawn, right? That was pretty synonymous. Now, again, we see over here, rejection, rejection, rejection. Over here uses as support, resistance, so on and so forth. To the buy side, clearly used as rejection, here used as support, right? So after we identify this, the next thing that we want to identify is specifically what? Identify the order block or blocks that are lying after the zone. So if I had to ask you guys this question, after you identify the key zone liquidity, where do you think we're trending at this moment in time, just based off of the limited information that you have? Are we going up or are we going down? Right? So what's just the most obvious? That's the thing I have to ask. And I know this is not trading view, but this is what's needed before we go to trading view. So in this instance, we're actually trending up, starting from left to right. You draw a trend line. We're bullish in this scenario. All these new sells, they're just there. That's not the pre-existing trend. So after we identify we're bullish, and remember what we said about the zones, we look for order blocks below the zones, identify the valid order block or blocks that would tell us that we're ready to buy higher now, because we're projecting a forecasted move. So what are the order blocks that lie below these zones? All right, boom, right? And that becomes pretty simple as is. You just then have to identify the order blocks that are lying just below. And we see here that exactly as you guys have analyzed, we have this order block immediately below, right? Below this level. And yes, of course, we also have this one here. So the next thing to do is anticipate what's going to happen. And based on what we've already done, we know that we have to collect some form of liquidity over here. We have all these traders here. We have these traders who are looking to buy here. No matter if there is an order block here, it will not work because it is aligned with a break and retest zone. It will not work, or key zone rather. So knowing it won't work, we can expect price to come lower, right, below to take out these buy stop losses. And then we can potentially expect what? Collecting the gas to get to what destination? Exactly. All of these equal highs, all the way over here. So we can expect this, or we can expect something like this. Either or, right? Now you'll know exactly which one has the highest probability of happening later on, but this is how you would approach it. And exactly like this. Great.